The chair now recognizes the ranking member of the Subcommittee on Capital Markets, the gentleman from California, Mr. Sherman, for 4 minutes for an opening statement.
We should mourn the Supreme Court's ruling of today that will make it much more difficult for the SEC to enforce the rules that keep our capital markets the safest in the world. This is the worst Supreme Court decision since yesterday, when the Supreme Court when the Supreme Court legalized corruption by saying that a mayor could give a $1 million contract and take $13,000 in cash, and that's just fine as long as you can't prove the quid pro quo. So I would advise corrupted officials around this country, simply don't put the quid pro quo in writing. You will be fine with this Supreme Court. I'm glad to see the SEC is doing its job. I've been here for 28 years and heard many hearings where they get criticized for not doing enough. They are discharging the mandates we've given them by statute, particularly Dodd-Frank. When it comes to our markets, there is the commission that you pay, and we tell investors, oh, zero commission, and then there's the spread. Investors are not protected unless they're getting not just best execution, but the most enhanced best execution that they can get. The SEC has identified $1.5 billion per year that investors are losing because while they're getting something that's called best execution, in the securities world, it's not enhanced best execution. And I'd point out that being able to tell people that it's zero cost when it isn't zero cost is a way to encourage the gamification and day trading that is unfortunately part of our capital markets. I am pleased to see the SEC is moving in the right direction, and I hope they will work with FINRA to best work to make sure that investors know not only what is the commission, but what was the spread and whether a better execution could have been available to them. I'll point out that 90% of the retail orders are going to wholesalers. We should, as a government, do everything possible not to encourage the use of these wholesalers, because when instead that trade goes to an exchange, we get the public is informed. We have the consolidated audit trail, and this is critical to the effective capital markets. When it comes to crypto, it was in 2022 in this room that I told the SEC that if crypto was an unregistered security, that the crypto exchanges were trading in unregistered security. They have finally moved in that direction, as well they should. Unfortunately, Congress, the House, moved in the wrong direction by passing FIT 21, which not only has an effect on the crypto world, but offers an opportunity to take traditional stocks and bonds and tokenize them and avoid the whole securities regulation process. It is the passage of FIT 21 that causes me to say something that I never say, which is thank God for the United States Senate. When it comes to trading, remember that spread is very important. The spreads that are available on big stocks like Apple and Amazon are roughly 1/10 what crypto traders are paying for Bitcoin and Ethereum. So we have efficient markets for major stocks, and we have fleece the investor margins or spreads when it comes to crypto. And finally, one thing the SEC hasn't yet dealt with is how the exchanges have totally insulated themselves from liability when they make mistakes, thus shifting the costs of that liability. And I refer to, I think it was the Facebook offering of a decade ago, shifting that liability onto the practical effect of the liability onto the brokers. And I look forward to explaining that as well, and I yield back.
So, Mr. Kennedy, I alluded in my opening statement to the situation where an exchange can have a technical glitch and investors can lose tens of millions and hundreds of millions of dollars. It happened with the Facebook offering over a decade ago. I like to understand how customers are made whole for the losses that they suffer when you have this glitch. Could you describe how the exchanges contribute to paying those investors when the glitch occurs under the current rules?
Absolutely. First, what we do, nothing is more important to us than the resiliency of the markets. And I think we all try not to take it for granted, but we at NASDAQ and our fellow exchanges that I'm representing today invest constantly in the resiliency, 24/7, teams working around the clock. But that said, Congressman, things happen. And we understand that those things happen. We have a very transparent rule set where we're able, through the SEC, to give back what we call accommodations when we are at fault to the best that we can. And we also will file...
If I can interrupt, you do have a $250,000 limit on your liability that was created by the exchanges themselves. I can understand why you couldn't have unlimited liability. You might go bankrupt. That would be terrible for the entire country. But it occurs to me that you should be able to get insurance that would cover more than $250,000. Because when I say $250,000, that isn't $250,000 per investor. That's $250,000 for everybody who bought Facebook. Could you get insurance that would allow you to have some limit that would be much higher than $250,000 for the whole country?
I would have to get that answer from my team, my legal team. I just don't know, and I don't want to suppose. But as you know, the markets are extremely intertwined, which is why we're here today, to talk about the interconnectivity of those markets.
I do want to move on to another question. Broker-dealers registered with the SEC and FINRA undergo examinations by both agencies, although FINRA's are more frequent. Presumably, if this best execution were adopted, SEC examiners would review broker-dealers for compliance with the SEC's best execution regulation, while FINRA examiners would be reviewing for FINRA Rule 5310, covering the same material. Professor Bograd, would broker-dealers be required to have separate compliance programs to meet these two different best execution obligations?
Thank you for that question, Ranking Member Sherman. I am not a compliance expert. The SEC's best execution rules seem to be stricter than FINRA's. It is unclear how the two organizations would deal with that conflict, given that FINRA is a SRO and SEC is a government regulator.
Should FINRA simply repeal their regulation and say, as long as you live with the SEC regulation, you're fine with us? Or should we have two separate regulations in that area?
I would think it would make more sense to have one uniform regulation.
Mr. Ramsey, we've seen this Supreme Court decision that creates a big federal jury case about every SEC enforcement effort. What effect is that going to have on the ability for us to rely on our capital markets being the envy of the world? And I realize you haven't had time to read the decision.
I have not, and I'm certain I'm not enough of a legal expert to give you a definitive answer. I would say that certainly the SEC has relied on ALJs for a lot of cases now. I think they have increasingly been relying on the courts. I'm sure there are cases where it would make their job more difficult and increase the burden of catching wrongdoing, but beyond that, it's hard for me to tell you how much of an impact it
And how
might
would
have.
allow trading in sub-penny increments benefit retail investors in pension funds?
Yes, I think that's very critical. And I note that several of my colleagues, even though they said that they were concerned about not moving ahead, suggested that moving ahead to half-cent ticks could be helpful. The important thing is that it means that prices can then trade where people want to trade, and that means that the bid-offer spread, which is so important because it defines every other pricing metric that people use in the market, it means that those prices more accurately reflect the prices that investors can then get. So it's basically more money in the pockets of investors because the prices that define what they can actually achieve are better.